Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 259th podcast, VideoCast for the week ending October 2nd, 2024. We're going to try to keep this one under an hour. These things have been going 2 hours every week because we've had so much to talk about. But when everything's working and you have a record, unbelievable situation going on, there's not a whole lot to talk about. As I always like to say, we spend 80% of the time talking about the ones that haven't moved yet, and 5 or 10% celebrating our winners. So for everyone listening in, China's working. We don't have to spend a lot of time on that. All right, family first, then we'll get down to business. Awesome weekend in Orange County. We did California Adventureland and Disneyland. Want to thank my new friend Wallace, who set us up with the whole VIP experience and Club 33 and 1901 and all those exciting things. Very, very grateful. There's the girls and Caitlin. That was at Adventureland. Then there's Mimi and Annabelle in the teacups, or the tractor teacups. This was really interesting. This is a photo with Walt Disney, his statue, when we just got in. And there's a quote here you can enlarge. It says, it's from Disney himself, quote, "We're just getting started." And it's so apropos for what is happening with China finally after all this time and excitement. So here's another picture. Here's a picture with Mimi. And this is at Club 33 before we went up. Pretty exciting there. Same thing. And then on to last week and this week, Fox. Did Fox on Friday and on Tuesday. Back and forth. That's in front of the building. This is the green room for those of you who like to see behind the scenes. This is On-Set Studio D. This is also where not only Stuart Varney and Lauren Simonetti record, but also Charles Payne. So, and then this is with Liz Clayman on Friday. That's the other side of the building. That's also where Brian Berenberg and Big Money. And then this is me showing off my 1901 jacket that my buddy Wallace got. This is the green room for Liz Clayman's show, which was pretty awesome. And speaking of which, want to thank Jake Mack, Catherine Myers, and Liz Clayman for having me on Friday with Keith Fitzgerald. Friend of mine for sure, completely different strategies. But like I said, there's many ways to skin the cat. So let's listen in here.
Let's just get to the floor show because it's Friday. Joining me now, a Great Hill Capital Chairman Tom Hayes and the Fitzgerald Group Principal Keith Fitzgerald, who said that Costco analysts have got it all wrong. He sees a positive here. First, I'm going to turn to Tom Hayes, though, and get the macro picture as we finish up a week that's had so much news and a few decent records and gains.
Yeah, I think we've had 2 regime changes in 2 weeks, Liz. So the first was the Fed front-loading 50 basis point cuts, which implies a couple of things are going to happen. We're going to see follow-through with the Unmagnificent Seven outperforming the Magnificent Seven. We're going to see continued outperformance of small caps versus large caps. First 12 months after a cut, you get 11% outperformance of small caps. And everyone's loaded into defensives. I think we're going to move back to consumer discretionary over consumer staples. And that second regime change was the fiscal stimulus bazooka. Emerging markets now outperforming developed markets with China on the tear.
Okay, but you say Russell 2000, the small and mid caps. When you say the Unmagnificent Seven, remind our viewers who's in there.
Yeah, Unmagnificent 493 and Magnificent 7. So Unmagnificent 493 will continue to outperform the Magnificent 7, which is Amazon, Google, Meta, etc.
Okay, so you're saying the rest of the S&P is much more magnificent.
It's much more magnificent. It's a sea change that started to take place in the last few weeks and now accelerated with the 50 basis point
Oh, you're
cut.
talking to Keith Fitzgerald, and he's
excited.
been loving and making a lot of money off NVIDIA. Keith, what's your answer there to what Tom's just said?
I think that is just pure genius, the Unmagnificent Seven, and I love it. I'm going to have to borrow that, with due credit, of course. I think that tech is not all the same, Liz. And so, as you know, certain companies are going to do better than others. So Amazon's got its challenges, Meta's got its challenges. But companies like NVIDIA, for example, are going to run right back to the front of the pack. Whether it's the Unmagnificent or the Magnificent remains to be seen, but plenty of party-starting proposition here.
Okay. I got to get your thought on Costco, because while the official earnings season has not yet begun, it begins in a week or so with the big banks. Costco came out with numbers. What are you saying the analysts got wrong that's sending the stock lower?
Well, here's the thing, right? Costco is one of those things, trade the news or trade the reality. And the reality situation is I'm not sure they were looking at the same report I was, because I saw sales up, I saw earnings up in the billions of dollars. But the key takeaway here is they didn't even glance at this. 50% of the new memberships that Costco is selling is to under 40 age consumers. That suggests to me there is another group of Costcarati in the blooming that could power this thing for decades to come. The fact that it's down today is purely a technical move and an opportunity.
Tom's going to steal cost karate, so you guys will be even here. What's your counter to that, Tom? I mean, how do you feel about the U.S. economy? We do obviously see that inflation is moderating, continuing to moderate, although the core year-over-year PCE 2.7, while it matched, it's still hotter than a year ago.
It's Goldilocks. I mean, things look good. The only thing I'm a little worried about, by the way, whenever Keith talks, I listen. Keith is a good buddy of mine, so take a look at those names. The skew, option skew, is the cost to insure 1 and 2 standard deviation corrections is at 10-year highs. So it doesn't mean you're automatically going to get a correction, but, pre-election volatility is pretty typical going back to 1955 in the month of October. So we are staying fully invested, but if you're on margin, I would get off margin. We're going to ride out these bumps, and then once the election clears, we'll get a year-end rally.
Okay, a year-end rally. I'm wondering if that would include, Keith, Intel. Intel, of course, has been at the center of individual stock headlines this week, and at the end of last week, Bloomberg's got a report. The Wall Street Journal's got a report that, private equity might come in, and maybe Qualcomm, maybe who knows what, ARM. But one thing that's been reported is that Intel's pretty much rebuffed a lot of this.
I got to tell you, Pat Gelsinger, I've met him several times, is as bright as they come. He's the right guy at the right time for that company. The problem
is... I mean, he's lagging here. He's been at the helm for a couple of years. We like Pat, too. We like him, too.
I know, but you cannot turn a huge ship on a dime. The problem is the company has missed mobile, missed AI, missed the cloud, missed a lot of things that are a lot of years in the making. So I think, unfortunately, Intel remains dead money. I don't know why they rebuffed these offers, because that could have been salvation. It seems to me that there's a lot of blunt thinking inside their headquarters right now, and it's going to be bad for shareholders.
Okay, well, at least for the week, I see Intel up about 8.7%. Guys, give me your sense next week as we barrel toward what will be the September jobs report. It's really become labor that's at the focus for the Fed. Is it not, Tom?
Yeah, no question about it. I think that's where you could potentially see some volatility. You have obviously the inflation numbers later in the month, but the jobs report is critical. And everyone's pretty happy right now. Sentiment is still mixed. When I looked for things to hedge or short, I found it very difficult to find in the portfolio. The only things that were ready, in my view, that seemed overvalued were utilities and staples, which you don't want to short defensives into a correction. So I think let's see what the labor numbers are. Things look pretty solid. We expect a little bit of bumpiness in October. But again, as long as we get gridlock from that election, Liz, we're going to be fine into year end.
Okay, Keith, we got to go. But Tom said, listen to Keith's picks. And I will tell you that had our viewers listened to you a couple of years ago about one particular stock, stay in it, they would have made a lot of money, and that is Palantir. And we look at some of the gains here. It's quite unbelievable, hitting brand new records. Not unbelievable because you've been here telling us about that. Where does this stock go?
You're very kind to remember that. Thank you. I think we're going to take out 50 pretty quickly. I'm starting to think about 85, but 3 to 5 years from now, there's zero doubt in my mind we're looking at $100 a share. So it's going to be volatile, going to be a tough stock to own, but I encourage people to stay with it if you can.
Yeah, big data aggregator. Great to see you both. Have a good weekend, gentlemen. The maker of
And we're back. And then on Tuesday, I came into the Israeli war situation and the port strike and talked about that in real time with Stuart Varney and Lauren Simonetti. I want to thank Christian Dagger and Preston Mizell and obviously Stuart Varney and Lauren Simonetti and also Liz Clayman as well for the previous one. So here we go.
Please pull up the Dow Industrials, the S&P, and the Nasdaq, please. They're moving south. That is because the U.S. has indications that Iran is preparing to launch a ballistic missile attack against Israel. That will be a very, very serious development in international relations, an extension of the war. And we'd like to know what our response, what America's response would be if this happens. I think that's weighing on the market. Now, let's get back to the dock strike. 45,000 workers on strike. Tom Hayes joins me to watch the market for us. Do you expect Biden to intervene within a week? As I'm suggesting that in my opinion piece there. What do you say?
I absolutely agree with you, Stu. I think Biden's going to intervene. He just doesn't know it yet, because effectively the last thing you want to see going into an election is 401ks going down and the cost of eggs and wood and all the supplies to North Carolina going up. This could be, if they fumble the ball, the best thing that ever happened to Donald Trump in terms of the election, because right now, we front-loaded a lot of shipping into the East Coast. So for the next week, it's only going to cost $3-4 billion. After the first week, it could start to cost $4 billion a day. People are going to feel that. And we're in a seasonally weak period of the stock market. As a matter of fact, in elections, the next 10 days, election years since 1955, are the most volatile and the lowest returns of the year of an election year. So you compound that with Israel-Iran, you compound that with the strike. I think he comes in a week and a half and says, if it's not resolved beforehand, and says, we're going to let this cool down to, I don't know, sometime in November.
Well, okay. right. But, so you are telling me that if the strike lasts, 2 weeks, say, the market will take a hit, regardless of what President Biden does?
No question about it. Yeah, I think the market's going to start to extrapolate what that means in terms of, 50% of the ports shutting down, can't get goods. Walmart's going to be hit. Home Depot's going to be hit. And then people will worry about the holidays as well. So certainly the public will, even though a lot of the holiday supply has come in by the end of September. As things run out, as price, look, consumer confidence, it's been kind of dead on the mat. Why? Because prices are up. So if prices start to tick up again, and they associate that with the Harris-Biden administration, it's really going to bode well for Trump going into the election.
I want to get back to this breaking story. The U.S. has indications that Iran is preparing to launch a ballistic missile attack against Israel. Yeah. I'm saying that that is part of the reason for the market's decline. We're down 330 now on the Dow Industrials. Is it a big negative for the overall market?
I think so. We had indications of this headline mid last week, and we saw this type of volatility mid last week. This is a factor, and you have to think about.
See that on the screen right now? The yield on the 10-year Treasury is down. That is the result of a flight to safety. That's people putting money into dead-safe 10-year Treasuries. Is that 10-year? Yes, it is the 10-year. Forcing the price up and the yield down.
That's right.
Flight to safety. That's my opinion.
VIX is up. Oil is up 3%.
Oil is at $70 a barrel, I think, on this breaking story. It's happening as we speak.
It's interesting,
One more point.
That last time I was on, I said, if you're on margin, come off margin. And the reason I said that is the skew, which is the price to insure against a 1 standard deviation correction. Think of 10% correction. Hit 10-year highs in the last week. That doesn't guarantee a correction, but it indicates that we're fully invested, but we're off of margin. We'll ride out these short-term bumps through the election. I think we'll do fine after the election. But you have to keep that in mind. We've made a lot of money.
Don't borrow money to buy stocks.
Exactly.
It's not a good
not right now, yes.
Tom Hayes, good stuff today. Thank you very much indeed.
And we're back. And here's the quote of the week. To buy when others are despondently selling and sell when others are euphorically buying takes the greatest courage but provides the greatest profit. I can't tell you how many of you came to me and have expressed your gratitude for hanging in there and buying in the hole when no one was, and we were buying every single week it was red. And now you guys have made a ton of money. Damien, new buddy out in Santa Monica, same story. Started in the hundreds, brought his basis all the way down to the mid 80s also. And he's smiling so wide he could eat a banana sideways, and all the great emails. Very grateful, but you did it. You stuck in there. You did the work, and now this thing will run up. Everyone will want to buy it at 120, and then we'll consolidate for a little while, and everyone will say, "Oh, it's just another fake out," and that'll be your final opportunity before takeoff. So very excited on that front. as great and most incredible as things are rocking and rolling, just want to keep in mind that we're just getting started, as Walt Disney would say, because most of our great picks are just now beginning to leave the station. You know, Baba, as much as it's moved 70% off the lows in a handful of minutes, this will consolidate and this will work higher. There's no question about it. Baxter, same thing. It's moved a lot from 32 to 40, but again, just getting started. This thing's going to work higher over the next few years with the turnaround plan. $2 billion of costs out of the business, $13 reducing costs. They did what they said they were going to do as far as selling, deleveraging, doing all the plans. CPS, we just got great auto sales in September, up from 15.1 run rate in August to 15.7 in September, and that's before the cuts and incentives even start into year end. So very excited about that. My goodness, it would have been the best quarter of ever. It might have been, but might have been the best quarter of ever if you had CPS also. But I think CPS is going to be the fourth quarter story, which we're very excited about. Disney, I can't tell you how crowded the parks were and how amazing the experience was. Nothing to think about there. They're raising the prices at Disney Plus. People have to have Disney if they have children. If they don't, social services comes in and takes your children away. That thing is off to the races. Generac, same story. Sad story for the people in Florida. I hope everyone is doing well, managing through it. But this demand is going to continue to increase and increase with the unstable grid and electricity demand. Intel, opportunity of a lifetime. We bought in the high teens as it flushed out. We'll probably buy some more if it goes back and retests. Small caps just working their way higher. I think this is, again, a fourth quarter story after the election, like it usually is. November, December favors small caps, and that's when we break to new highs, which is pretty exciting. As you know, we got rid of the big banks over the summer, took profits, but we kept our regionals. This is going to work higher with small caps over time and to new highs. We're excited about that. PayPal, rocketing off the bottom from 50 to 80. However, it's just getting started, ladies and gentlemen. Yes, it's a huge move, and yes, it'll consolidate, and yes, it will work higher. This is a huge position for us as well as Baba. Stanley Black & Decker breaking out here from this consolidation range. It'll consolidate and work higher to new highs over the next few years. This is the most exciting time ever to be involved in markets and picking stocks, because this once-in-a-100-year situation with COVID created the most incredible, amazing opportunity. That's slipping away from us, by the way. If you don't get new money in, in the next couple of quarters, you can still do well, but the wholesale opportunities that are still out there, yes, they're moving up, and yes, we are super excited about that, but we want everyone on the train with us to take full advantage. And it's unbelievable because, in the case of Baba, it's like, so you bring your basis all the way down to the low 80s, and then, boom, it shoots up to 115. But the options we had, it's staggering what's happening with some of these 4, 5, 6x, 7x, and taking a little bit of wins on those that expire in January. It's unbelievable. And VF Corp, little old VF Corp is now knocking on the door at 20. We haven't even had a time to talk about it. It's up from 10 to 20, and no one is even paying attention to it. I love this stuff. Biotech also starting to break out. I mean, it's been all of this stuff. And remember, we kept saying, wait till the Fed cuts, wait till the Fed. Well, it's here, ladies and gentlemen. Small caps, China, biotech, small cap. The whole thing is playing out according to plan. Let's talk about some of the data for the week. Consecutive weekly declines in U.S. 30-year mortgage rate. 8 weekly declines. This is going to continue. I think we'll see it went from 7.2 to 6.12. I think we will see a high 5 handle maybe by the end of the year, certainly by first quarter, and that's going to ignite the housing market, which will further benefit Stanley Black & Decker, further benefit Generac and others. Gavical put this out over the last 2 decades. China has had 5 big equity rallies, 3 of which have been fueled by stimulus. We could be at the beginning of a 4th stimulus rally, which raises expectations of 50 to 100% gains. It's so interesting to see all the groups that were excessively negative on China and bearish, now that they're up, 50, 70%, a lot of these stocks off the bottom in a matter of weeks. they're all saying they're excited and just getting started. And so they were telling people to sell 50% ago, and now they're telling them to buy, which means we probably consolidate at some point in the next few weeks, and then punish all the ones chasing at 120, 130, and then they'll sell back at 110, and then it'll take back off to 150. So we covered that last week. HSI shares has triggered its strongest breadth advance in history, a classic bull market initiation signal. So that's good news. The cost of bearish bets slumps as China stocks rally. Global monetary easing. September saw the biggest month of easing since April of 2020. This is something we've been talking about for months. That's playing out. Did you want to be a buyer or seller when this type of easing happened in the first quarter of 2020? You wanted to be a buyer, and we were. Go back to the podcast tapes. We were one of the few, and it was one of the biggest, most incredible years ever. And then 2009, same story. So that's that. This shows the seasonality of the first 10 days of October in an presidential election year from 1928. This is the most volatile, negative period of the year. Doesn't mean it'll necessarily repeat, but it's nice that we've built up some cash. We sold Solventum in the last couple of weeks. We sold, and we took a lot of profits across a slew of options that were up 4, 5, 6, 7x spreads, etc. And then after the first 10 days, you move into a more favorable period, and then following the election straight up, that's a positive thing. Okay, so this is talking about if the market does well from July through October, then the existing party stays in power. If it does poorly, the new party gets in power. That makes sense. We'll see how it plays out this time. There's this consumer confidence factor. And as I said on Varney, if they fumble the strike and stock prices, 401ks start to go down and prices start to go up, that could change the whole dynamics. If they get to it quickly, it's probably we'll see how it plays out. But I think as it stands, the Republicans will get the Senate, the Democrats probably get the House, and the presidency is a coin flip based on what happens in the next few weeks. Economic surprise index, this is turning up. That's what you see in expansions, not contractions. Median floor area decreased. Remember, we've been covering this for 3 years. We said not every starter home needs to be 5,000 square foot with an indoor pool. That people can actually have 1,000 and 2,000 square foot homes, and like they did in think Levittown in the 50s, that's starting to play out. That's going to allow a lot more people into the starter home land, which is a good thing. Long dated U.S. Treasury returns near 62-week lows. So we've had that huge rally off the bottom. I think that's going to consolidate for a while. U.S. large cap 10-year rolling returns well above historical average. I think that's overdone a little bit. Give small caps a chance. Give emerging markets. Emerging markets outperform developed, which we covered on Liz. Small greater than large. Small greater than large. Emerging markets greater than developed markets. Value over growth, unmagnificent 493 over magnificent 7, and consumer discretionary over consumer staples. Those are the themes going forward. China MSCI earnings per share trading at forward EPS is 6.5 times. It's unbelievable. And this is just showing at the bottom of the range. MSCI profit margins are going up in the last 2 years, not down. This is MSCI China, by the way. This is all from Yardeni. Valuation multiple, again, high single digits still, even after this rally, which is super exciting. Here's a list of drawdowns from Wisdom Tree. Russell still trading below. We like Russell small caps, Russell 2000, and emerging markets. These are your two big money opportunities, ladies and gentlemen, for the next 18 months. That's going to continue. I can't stop posting this chart with China short. China equities was one of the most crowded trades for the last few months. that they can't even get out of their shorts. Could you imagine? These guys are upside down 100% in a matter of weeks. You're going to see a lot of them blow up, the people that have been short, and that's the story. Emerging markets versus developed markets performance. You can see it here. Hockey stick straight up. Cyclicals versus defensive starting to pick up now. Everyone crowded into defensives ahead of the cut. We covered the economic surprise index. Here's the composition of S&P equity capitalization. You can see tech at 32%, but they're only 21% of the earnings. So that's why we say large cap underperforms, or Magnificent 7 underperforms on Magnificent 493. You can see sector by sector. I think an interesting story here would be financials at 21% of the earnings and 13% of the weight. So that speaks to the small cap. That speaks to the regional bank index that we still hold. Here is from Bank of America. S&P defies gravity in seasonally weakest month. So that was September. Strongest Q3 since 2020, marked by a big rotation. Equal weight S&P jumped 9.4%. versus the cap-weighted S&P 5.5. What does that mean? Unmagnificent 493 outperformed a Magnificent 7, which has been our theme for weeks and weeks and weeks. We've been talking about this. It's played out. 67% of the stocks in the S&P 500 outperformed the index in Q3, 98th percentile in history. Historically, only 31% of the stocks in the S&P ever outperform the index. Value over growth for the first quarter since fourth quarter of 2022. Dividends shine. Mid caps break out of the middle of to lead September. Mid caps were up. Let's see. Like the rest of the investment after leading the quarter. Okay, so mid caps are taking off. Stocks you don't pick make all of the difference. So 69% outperformed this quarter, which is exciting. And then indices. So this is interesting. I highlighted energy because it's doing so poorly. Energy and materials are two areas I've got my eyes on. As it relates to energy, we have Comstock. We think that's going to work higher. That's plenty. But we are looking at we're not looking at the integrateds. They're not cheap enough for us. We are looking at some of the servicers. We may have more to say about that in coming weeks, but for now, we have nothing to say. Materials, we're looking in that space. We have a small position we've talked about in Albemarle that's starting to take off the mat, but nothing there. But that's an area that we're starting to spend more time looking at. And then index relative price return distribution analysis. So yeah, you can see energy and materials have underperformed. So we think that's going to be the story maybe late this year and certainly next year. Healthcare, a lot of opportunities. Biotech's going to work higher. Raising materials to overweight from market weight. Again, that's from Bank of America because of China's stimulus, because Fed cutting into an accelerating profits cycle means reflation. Long onlys are underweight materials. A decade of underinvestment in manufacturing. We're seeing that construction manufacturing start to take off. Dr. Copper is turning up. And new household formation is next because why? Engagement recovery is happening. Searches for engagement rings are up significantly in recent months, according to Signet CEO Drosos on September 12th. This makes sense to Lorraine Hutchison. Typical 3-year cycle of meet date engagement was stalled by COVID, but likely recovered by 2021. New household formation generally follows, which is linked to materials returns, new housing formation materials. So we want to take advantage. Underinvestment in structured tangible capex since 1990. That's starting to pick back up. Materials trades below its historical premium. So again, we want to look. Let me make another note to myself. Find some action in materials. Find some action in oil servicers. And we'll see how the opportunity presents itself in coming weeks. Bank of America analysts positive in the last 3 months on industrials and materials. So they're doing more upgrades than downgrades. Sectors that do well after the first cut, looking out, healthcare is one. So that biotech that we have is going to be phenomenal. And we're going to get paid just like Baba for waiting, and we're going to get paid bigly, as they say. Biggest relative overweight in defensive versus cyclicals since May 20. This is what we've been talking about. That's started to change now. The discretionary are outperforming the staples. I think we'll have some opportunities in October to pick some up on the cheap, which is why we've raised some cash, which we're excited about. And risk appetite is at 11-month low, so dips are to be bought. People are still skeptical. Then you've also got tax loss harvesting, brace for a red October. Tax loss harvesting from institutional investors became increasingly prevalent after the Tax Reform Act of 1986, which mandated October 31st as the cutoff for most mutual funds to realize capital gains. Tax loss selling by institutional investors in October is also empirically borne out by flows and performance. Since 1986, stocks down 10% or more as of September month end have consistently lagged the S&P in October by an average of 85 basis points and a stable underperformance hit rate of 63% before November's bounce back. We screen for S&P stocks down over 10% year to date, underweight by long onlys, and they go through a bunch of lists. So U.S. stocks that can, this is not that list, this is a different list first. U.S. stocks that can benefit from a rally in Chinese equities. For those of you who are scared to own China equities and missed out on all of this, what comes to the top of the list? Generac, Estee Lauder, and Stanley Black & Decker. So we're getting 2-3 bites at the apple. U.S. stocks with sales exposure to China that are going to benefit. Qualcomm is interesting. I wouldn't mind seeing the Qualcomm Intel. I don't think it's going to come together. I'd probably buy Qualcomm discreetly, but Intel is a better deal for me. But if they came together, I would hodl till the cows come home. Other companies that have sales exposure to China, i.e. as China recovers, they'll benefit. Las Vegas Sands, Intel, let's see here. APD, I want to look at that one. eBay, I didn't realize that. That's interesting. Starbucks, obviously, Nike, Lululemon, Wynn Resorts, obviously. All right, dividends likely to contribute more to total returns than during the last decade. We've covered this. Dividend yield is still inexpensive relative to history. It hasn't been this cheap since 2001. This goes back to our repeated analog 2002 to 2007. Hedge funds exposure to cyclical versus defensives is just off an all-time low, which is why you want to own cyclicals. They've been underweight. They will be chasing up just like they're chasing in China and late to the party. And then long and short, the longest and shortest sectors. The shortest is energy. So again, I think we're going to see some opportunity there. Hedge funds have the highest relative exposure versus the S&P to industrials, lowest to energy. So again, energy, there's got to be a pony in that pile. We have Comstock. We're going to probably add a servicer, and we'll take it from there. Commodities, 10-year rolling returns. Yes, it's at 10-year highs, but it's coming like off depression death from 2000 and a long way to run in that story. Fund manager survey, underweight resources, commodities, emerging markets versus history. They're going to have to play catch up. So energy again, industrials, emerging markets. What are they? Overweight utilities. So, we've talked about utilities. No one wanted them in October when we were pounding the table last year, and everyone wants them up 50-60% now. We think that's going to be a little bit long in the tooth. Has to consolidate those gains. Jobless claims sink to 4-month low. Businesses aren't hiring or firing many people. Macau hotel occupancy rate back to pre-pandemic levels. This is a big, big deal. That's indicative of China consumer and VIPs and the wealthy feeling better about things. Energy sector versus the S&P broke this downtrend. Most technical analysts say this is terrible. This is bad. I think this is still. I think this is representing an opportunity. Retail continues to have significant size bias in favor of large over SMID and mall cap. That's exactly what you want to take the opposite side is retail chases the large cap, the NVIDIAs, etc. And the opportunity is going to be in the small and mid and already is. Consumer sentiment starting to tick back up. This port strike, we'll see how it's handled, could take it back down. Temporarily, manufacturing and warehouse construction going through the roof in line with our themes we've been talking about. Construction spending is now ticking back up. Stanley, Generac, etc. We've been positioned for that. Job openings are ticking back up. That's a good sign, probably because of the rate cut and some positive outlook there. Job openings, monthly change. The biggest add has been in construction and food services and local government, excluding education. Manufacturing, we covered that. GDP now estimates for Q3 are at 2.5%. Economic surprise index, just hockey sticking up. That's what you see in expansions, not contraction. Ports affected by the strike handle about 25% of total U.S. goods imports, 2.8% of GDP, and 27% of total U.S. good exports, 1.9% of GDP. So it's totally material. It's not completely devastating. It's going to be a key of time. They can let it go for a week because they already front-loaded all the shipping to the West Coast and to the East Coast ahead of this deadline. But after a week, it's going to start to cost $4 or $5 billion a day. And then you're going to see the pain in the Walmarts, the Ikeas, the Samsungs, Bob's Discount Furniture, Home Depot, etc. We covered this last week. Hedge fund billionaire David Tepper says he's loading up on China stocks after the nation's stimulus bazooka. So after they're up 50, 60%. But he also had BABA as his number one position in recent quarters. So welcome to the party. Intel and U.S. race to finalize $8.5 billion in CHIPS funding by year's end. That is going to continue and be a very positive thing for Intel moving forward. Moving on. China's Politburo supercharges stimulus with housing, rate vows, etc. So they did the rates. They lowered the mortgage rates on trillions of yuan of mortgages. They did the bond issuance for $250 billion of fiscal stimulus, and it's just beginning. They keep saying, we'll do more, we'll do more, we'll do more. And the market is finally believing them because they are doing what they say they're going to do. Next, hedge funds snap up Chinese equities on stimulus optimism. Add to that after up 50%. China's yuan continues upward climb after Beijing's stimulus rollout. So all the late money that's come in will have to get punished a little bit. My guess is we push maybe a little bit higher and then bang them out 10, 15%, let them sell in the hole again, and then just run it up parabolically, probably into year end and the first quarter. Hang Seng and China Internet outperforming the S&P year to date. That's funny. China is now outperforming the S&P year to date. Pretty wild. Alibaba's AI-powered cancer detection tool recognized on Fortune 2024 Change the World list. Is the Japanese yen reversing upward? The answer is yes, ladies and gentlemen. We've been calling for that for months. Hedging goes out the door with burst of China stock euphoria. Opinion follows trend, ladies and gentlemen. There's David Tepper. Central bank comments exceeded expectations. Those calling Intel a company in decline are missing the point entirely. It's now a corporate actor on the geopolitical stage. Recent coverage narrative, the sad decline of a once great American company and continued to outlook dim. But the story is really a high-stakes thriller leading to an uncertain resolution that could carry global implications. May take years to play out, but seeing the big picture takes each day's news far more interesting. They do the backstory. Intel Today, version of story, most interesting. Okay. The most interesting part, the grand strategy, great powers, geopolitics element. Semiconductors are crucial for both America's and China's national security. Only 3 companies can make leading-edge chips: Taiwan Semiconductor, Samsung, and Intel, which ranks in a distant third in output. That's why bipartisan congressional majorities in 2022 passed the CHIPS and Science Act, which subsidizes new chip factories in America. Gina Raimondo in February explained why we cannot allow ourselves to be overly reliant on one part of the world for the most important piece of hardware in the 21st century. So effectively what this article is telling you is what I've been saying for months, which is, oh, by the way, here's what's interesting. Quote, I fully expect that we'll need a CHIPS Act too. So they're going to get more and more money. Why? Because they're the only game in town. So Taiwan Semiconductor is not the region they want to fund. Samsung is not the region they fund. Intel is the only one that can produce these, and they've actually just started delivering their Gaudi 3 chip. which we've covered many times. And the government will continue to stand behind them because it's a matter of national security. Top Shell boss says U.S. unusually vulnerable to Middle East oil shock. I think the stage is set with everyone so pessimistic. They all wanted energy stocks at the top. No one wanted them at the bottom in 2020 when we were buying. Everyone wanted them at the top in 2023. And now they're pessimistic again. I think that creates opportunity. Chinese home buyers scout showrooms after midnight, at midnight after easing. So the minute the policy stepped in, the Chinese are back to what they love to do, which is buy real estate. And the game is back on. And it was just a question of how long it took them to cry uncle. They took about 12 months more than we anticipated, but it forced us to buy a ton more stock at lower prices. So the Christmas card is in the mail to Xi Jinping. Boeing stock rose despite effort, saying a share offering is coming. So they got to raise about $10 billion of equity, somewhat dilutive, probably already priced in. But once they turn the spigots back on and the cash flow goes, they'll just buy that stock in. And what that does is it saves their credit rating and gives them a little bit more leverage. Because at the end of the day, with all these strikes, as strong as they are and as organized as they are, at the end of the day, workers run out of money and they blink. And, I don't mean to sound callous. I'm telling you how this works out. The company can raise $10 billion. The workers can't. And so sooner or later, they're going to come to a reasonable solution. I mean, I think what's on the table with Boeing was up 30% in pay. What's on, the longshoremen are already making $150,000 a year to load packages. Interesting enough, if you go to China, all of these ports are completely automated. They have these automated elevators that take the cargo container off the ship. It goes on a truck that has an autonomous driver that takes the stuff where it needs to go. I mean, you can't make this stuff up. So, no one likes change. We all have to deal with it. I think that Boeing will come to a reasonable solution like the UAW and the car makers did. But eventually these things get resolved because people their rent doesn't stop coming in, their cell phone bill doesn't stop coming in, their car payment doesn't stop coming in. And usually it's about at a month of savings that most of the workers have, and then everyone blinks and wants to vote. So that's where it comes. They'll get more. They should get more. Prices have gone up, but like some of the requests on both sides, everyone starts with a big ask, and then they come to a deal that neither party likes, and that's the sign of a good deal when no one's happy. The workers won't be perfectly happy. The company won't be perfectly happy. They'll have given more money than they wanted to. The workers will have gotten probably slightly less than they wanted to, and everyone goes home and everything gets back to normal. China retail investors scramble back to the stock market. I don't want to miss the boat. There you go. That's everything you need to know. ADP jobs report shows 143,000 gain. Cooling in U.S. labor market leads to slower wage increases. Next, from Pearl Harbor to September 11th, here's how stocks typically react to outbreak of wars. So you can see here in the first day, you get mostly negative. And then the total drawdown ranges between 0% to 19%. I think we'll have some mid-single digits in October here, and they'll try to shore it up before the election one way or another. And then China rally spurs $7 billion loss for shorts of U.S.-listed stocks. World's smallest crocodile tears for that. And moving on, here's the article of the week. Sell Rosh Hashanah. By Yom Kippur, ? So Rosh Hashanah starts today. It ends, it goes to Yom Kippur, which is on the 11th. This is historically a seasonally weak period. We, going back to the notes on, for the shows that I was on, we didn't get to cover all of that. You can go through these notes. But as far as Baba, nothing has changed. And nothing's changed for the year plus that I've been talking about it every single week. The end of the day, you can buy it at 2014 prices, even after this rally. The only difference is sales are up now 1,300%, and earnings and cash flow are up 650%. So you tell me, what else is there to talk about? Seasonal weakness on tap, ? Here's the data from Jeff Hirsch over at the Stock Traders Almanac. On average, the next 11 days down 0.5%. So we'll get a little volatility here. Also in an election year that tends to be exacerbated. Here's from a gentleman named Scott Brown. October has been the worst month of election years, worse than September. And then here is Ned Davis, the cycle composite for the election year 2024. You see here, beginning of October gets weak all the way to the last week of October, mid-month spike, and then you get the election clear, and the thing absolutely rips off the bottom into year-end. We expect a similar type of analog for this year. This is from Ryan Dietrich talking about the October return after you've had a big start. Average is negative 3%. So tax loss harvesting we covered. But those are the reasons to be pessimistic short term. Here are the reasons to be optimistic into year end. China pushes for faster local bond sales to boost growth, i.e. more fiscal stimulus coming to a theater near you. Global liquidity is picking up after troughing in late 2022, 2023, isn't anywhere near euphoric levels and probably will hit peak around 2026 if it passes any prologue. Price returns during the presidential cycle since 1945. Q4 on balance up 2.3%. So even if you have a weaker October, you're going to see some recovery, meaningful recovery in November and December. Other reason to be excited, this is the most amount of cuts that we've seen since March of 2020. And if you were a buyer when we did that article in MarketWatch on March 23rd, when everyone was hunkered under the table, you can find it on the website, by the way. You can just go into the search bar, type MarketWatch, and it'll come up. Scroll back to 2020, March 23rd, market bottom the next day. This is a similar situation. You get this kind of easing early 2009. In March of 2020, those were generational opportunities to buy the right equities and take advantage. Global money supply is picking up now, finally, after troughing in, peaking in 2020, 2021, troughing in 2022, and now finally recovering in 2024. And of course, earnings growth still projected 15% plus for next year. The seasonality after the first 10 days of October turns positive, et cetera, et cetera. Also, first off, congratulations to all the new clients that came in this year. We're very grateful. We are now reopening to smaller accounts, the $1 million plus accounts again starting today, and will remain open for the next 2 weeks. To see if you qualify and to take advantage of this opening, click here. That's on the Hedge Fund Tips website. There's a contact form. You can click on Money Management and fill in your information. Make sure you qualify. We'll get on the phone, see if there's a fit, and then we can take it from there. Larger accounts can access bespoke service at their preference anytime. Here, same contact form. As always, not a solicitation. As always, this is opinion, not advice. Click on terms at hedgefundtips.com. And earnings for the consumer staples top 30 weights in the last 30 days were revised down by 2.82%. So we got to see staples. Well, there you go. Everyone wanted staples and earnings are going down. So that'll probably, as for discretionary, they were revised down less, negative 1.37. Let's see where that concentration is. Looks like Amazon. Okay, well, we took profits on that in the summer. Tesla. So the Mag 7 is what's getting hit there. And now, economic calendar. Let's just cover any major things that happened this week. We already covered the jolts. We covered total vehicle sales. We're 15.1 last print. Expected to be 15.6 for this month in September. Actually came in at 15.8. 15.1 to 15.8. This is unbelievable. This is before the impact of cuts. This is before the impact of end-of-year incentives. We're super excited. All right. Let's go to the questions of the week. Ask me anything questions. Let's tune in here. The first one comes from Ray Catrib, 5-month listener. Wish I'd heard about your podcast a long time. Love the disciplined approach and framework. Many thanks for sharing your wisdom. Well, many thanks for listening. Podcast Humana is on your radar. What are your thoughts on Humana? Now the stock is going down. Stock is 20. Okay, so let's see what's happening with Humana. We haven't done anything with this yet. We're not in a rush to do anything. We've got a lot of companies that we love. What is going on here? All right. Well, it's more on our radar now than it was when we talked about it a week or so ago. Yeah, there was something about the... what the heck was it? It was something about the reimbursements that they're going to get hit for a few $1 billion or something like that, I think was the news. 2025 membership for its top-rated Medicare plan. Medicare star ratings. Okay, so I'll look into that. That probably creates an opportunity. Let me put that down next to oil servicers, materials, and Humana. Not doing anything on that yet. No real change. I mean, we just look at the fundamentals on this call. That's like 1% of the work. And then you got to really dig into the business. And we haven't done that yet because we simply don't have a place for it yet. So we're happy with our current holdings. Tim Felmingham, I've covered this a million times, but let me emphasize for the new listeners. Because if you're on this, it's, we have a ton of people on this call. A lot of family offices, a lot of ultra high net worth, centimillionaires, half billionaires, and multi-billionaires on this call. And most of them got very, very successful as entrepreneurs. And the way you become successful as an entrepreneur is through massive action. And in this business, and that's why most incredible entrepreneurs don't do well as investors, because the biggest attribute of an investor to do well is massive inaction, sitting on your hands, doing a skilled framework. And, it's funny, the smart, wealthy people are great investors. The super wealthy people are great pickers of great investors. I was looking across, my accounts and all the incredible people who have invested with me. And I'm like, wow, this has been amazing what's taking place here with Baba and everything else, just starting, everything is clicking on all cylinders. And I say, as great as I feel about picking these stocks, these guys were much smarter than me. They just picked the right manager. They don't have to do this every day. I love doing it every day, but like as smart as some of these picks have been, they're 100 times smarter for picking the right manager. Like they must be saying, my goodness, like look at what's happening. And all I had to do was pick the right guy. So very, very grateful for that. All right. Tom, thanks always for the useful information you provide. It's very much appreciated here in the UK. You covered Intel a lot over the last few weeks. You see many positives. What needs to happen for Intel to become a buy now? There is no buy now. You think you're going to get the perfect day or the perfect week, you're out of your mind. You don't get multi-baggers that way. You get multi-baggers because you apply a framework, you look at solvency risk. We're looking at the guarantee, the implicit government guarantee, and they're going to ship the Gaudi 3. People are going to see how incredible it is. The Lunar Lake is going, the 18A. They'll get the $8 billion from the CHIPS Act. All of these things will start to click, but you're not going to pick the buy now. You're going to buy some at 23. You're going to buy some at maybe at 17. You're going to buy some at 25 maybe. And then, 2, 3, 4 years out, it's $40, $50, $60. And if they actually start producing these competitive chips, the GPUs versus the CPUs of their legacy business, which is worth $40 to $50, then you could have $100. But we don't know yet. They've got to deliver. But in the meantime, we look at our downsides pretty much protected. If they liquidated the company today, you'd probably get back, full $20, $25. It's trading below tangible book. And by the way, they're a company doing 50 some odd $1 billion of revenue that the U.S. government is dependent on for geopolitical strategic safety. So the last time you had a company that was fully backstopped by the government, it was called Tesla, because they were so intent on pushing these EVs. And Tesla was subsidized billions upon billions of dollars and created one of the greatest companies in the world. I think Intel has the opportunity to take advantage of that single-minded, because people can't just set up a fab. I mean, Intel is so far ahead of what anyone else could do. So as much as everyone wants to buy the ARMs and the NVIDIAs and the these AMDs and all that stuff, they are the designer. They are so dependent on the ability of TSMC, Samsung, or Intel to produce their stuff. They can design all day long. If they can't produce, they're worthless. So for me, that puts, and Intel's the only game in town. So effectively what's setting up with Intel is a monopoly. Government-backed monopoly, which are the greatest kinds of monopoly, which is effectively what happened with Tesla during its run. And so tell me how you really feel about Intel, Tom. All right, moving along. Thought this is from Mark Maiello. Interested in your thoughts on British American Tobacco. Look, cheap stock with a dividend. It's had this move. It's fun. There are better ways to use your money. Like if it was, it'll probably grind sideways and pay your dividend. But there are higher and better uses of capital than that, and we've covered that in recent weeks. The financials are fine, but it's like, it's a literal cigar butt. Ben Graham and Warren Buffett talked about cigar butts. That's a cigar butt. It's a declining business, but they buy back stock. They generate a ton of free cash flow from all the people that are addicted, and it'll continue for some time, and they'll buy some more addictive businesses like vaping and all the other stuff that's bad for people, and they'll continue to pay the dividend. But look, if it was cheaper, I would buy it, but I don't really love that stuff. Rue Reynolds, love the show, recommend it to all my friends. Thank you very much. And for all of you that have been listening in and getting tremendous value, the number one compliment you can pay me is to share it with one friend or more who loves the markets and help them out as well. Does Cooper Standard have big risk exposure to the port strike, which started October 1st? Or do revenues just keep getting booked and customers get their orders later? There's risk. There's obviously risk. 28% of goods go through there. However, their risk is not as big as 90% of the other companies that have the risk. And you have to make bets on kind of game theory. And I would assume that if this goes for more than a week and a half or two, Biden is going to have to step in or they're going to lose the election. And now Biden may say, listen, these guys pushed me out against my will. Payback's a bitch. I mean, there's something to be said for that, but I doubt the powers that be will allow that to happen. And therefore, I would bet on the obvious, which is it either gets resolved or more likely he can save face and say, look, this is holiday season. We have to get the goods in for Christmas. Therefore, I'm going to institute Taft-Hartley just until November to get maybe November 6th or thereabouts, just to get enough goods in for Christmas so all the little boys and girls can be happy with their gifts. And then they can go back to fighting November 6th right after the election. All right. Hi, Tom. Ronan Bitton from Israel, big fan. Hey, Ronan, look, sorry to hear about everything that's going on over there. I hope you're staying safe. Would like your opinion on ARE. Thank you. ARE is Alexandria Real Estate Equity. I'm not really in love. Yes, I like. Okay, so we did the Vornado quick double last year. Vornado's now back. It's going. I'm not in love with multifamily because there's so much new supply on the market and coming on the market and starts. Let me just look at their balance sheet. I think this one's going to be okay, but balance sheet, financial analysis, balance sheet. Debt is $12 billion. Cash is $500 million, but secured by property. What's the asset value? $33 billion. Or 38 is gross. Let's see. All right. Let's look at this. Yeah, this one's probably all right. I have to do a lot more work, but it certainly warrants doing more work. My general view is there's going to be a counter trend move in these REITs and utilities. So maybe rates back up a little bit for the short term, and that'll be your opportunity to buy. Very small yield for what it is, though, 4.4, and you're not really going to get. Yeah, I think it's okay. See if we get a little yield back up. See if when you get a correction in utilities, this would be a time to buy this. But it looks not bad. I just not for me. Kyle M. First off, you mentioned during your VFC deep dive podcast, you rarely hear from folks. Oh, you rarely hear from folks about calls that go right, and usually only hear the ones that haven't started moving yet. Thanks for the education on Bob, and congrats on the call. Okay, so he's asking about Advanced Auto Parts. Advanced Auto Parts, fine. They de-risked. The problem is what's the EBITDA moving forward? And they're doing. We did a deep dive on that like a month ago. Nothing's really changed. He's asking if I've added. We have added at the margins, but not like Baba added when Baba was down. This has never been a core position. This has been a good size position, but not huge. But we're comfortable with it here. Maybe we'll add a few more shares. There's just no catalyst until the next earnings call because they already told you that they're going to be weak this quarter. So it's just going to languish until it finally takes off and people realize the significance of the sale and the deleverage and the impact to cash flow and the turnaround. So it'll just hang there, but no change other than he's executing exactly what he promised he would, and we're comfortable with that. That's Shane O'Kelly, who ran HD Supply for Home Depot, $7 billion business. That was a beast and still is. Wanted to ask you about WBA. This is from Jan. Jan, I cover this every week. It's not for me. Until they take the locks off the doors and they do some type of criminal reform where if you steal something from a store, you actually go to jail, I'm not really interested. This is a complete... They're going to figure it out. There's an enormous amount of value and there's only 2 players left, but they're just hiring better uses. So all that would be is just a trade. You're looking for a double bounce off the bottom, and it's not what I do. Yuki Nishikawa. I mean, here's how I think about it, by the way. It's very simple. This is the way you should go into every company. If JP Morgan was going to finance me to take private the entire Walgreens Boots Alliance, they would give me a credit line for whatever it's worth now, tens of billions of dollars. And I had to be the equity and put up 90% of my net worth to take the company private with JP Morgan's financing. Would I put 90% of my net worth up to buy Walgreens Boots Alliance at these discounted levels? And the answer is no. Therefore, I'm not going to play it for a double trade off the bottom. Thanks for the great lessons you teach. All right, so he's asking this is from Yuki in Japan, what has to happen for Advanced Auto Parts to get the same multiple as AutoZone and all that stuff? It's going to take time, but I don't know if they'll ever get that multiple, but they don't need to for it to be, a double, triple plus. It's just going to take a few years. Jimbo Jones, could you review Valet? Okay, I keep looking at Valet and I keep passing, and I keep wondering why I keep passing. Let me just see, because this is a materials play. I think you'll be okay here. I just think that there are better plays in the space, and yeah, I mean, I think the cash flow and revenues are going to pick back up, but that's why the stock is down. So it's not a big surprise. I just think it's milquetoast. It's not like I can't see myself getting a multi-bagger here. So why even tie up the capital? Occidental Petroleum, because they're doing carbon capture. This is from Eric. Oxy's not going to move because they're doing carbon capture. I have no interest. I don't think the integrateds have come down enough for me to be interested, and everyone keeps getting faked out because Buffett keeps buying it. The problem is, what they don't realize is Buffett is exercising warrants that he got here in 2019. Look it up. He did a debt financing and got a ton of free warrants at $59. So he's exercising those warrants. He's not buying new stock as everyone thinks he is. So for me, the time to buy it was in 2020 when we were buying ExxonMobil hand over fist in the hole. Now that it's up 8-bagger, everyone can't, is it? No, it's not for me, because it's not going to double from here over. I mean, it might double from here, but it's like Comstock could be a multi-bagger in my view, and that's where I want to take risk in the space. And I think some of the servicers are getting to the point where they could be at least doubles or triples. What amazing week in China. This is from Sagar Kanakia. Thanks, Sagar. I know you've been listening for a long time. So he's asking about Stellantis. The answer is no. They keep asking me about the car makers. I don't want to be in the car maker business because effectively all they are is annuity companies and health insurance companies that happen to make automobiles. They're controlled by the unions. Their margins are going to go down. They're going to be forced to produce more cars. It's going to be a race to the bottom. And we are going to benefit from that race to the bottom because we are the arms dealer with Cooper Standard. So not interested in that. Am interested in higher volumes as they race to the bottom, and we will take advantage. Could you please take a look at Kohl's? No interest in Kohl's. That thing has been dead money for a while, and I think will continue to be. Amazing past week for China. Okay, we covered that. It's amazing how exciting everyone is now. By the way, good stuff on Bava. Thanks, Kayla. Humana has taken a precipitous drop. Yeah, I'm looking at it. Not doing anything with it yet. Boeing management potentially diluting shares a concern? No, that's a positive because they keep their investment rating. They get more staying power against the unions. They'll negotiate a better deal, turn the spigots back on, deal with their backlog, start to generate cash flow, and buy back the stock. Damien Langier. Oh, sorry. Okay, so with that said, just make sure I'm not missing anything. Yeah, that was from Nolan about the AutoZone PE. Just going to take time. New Deep, Beyond Meat, Beyond not interested. I don't care if it's down 9. He says it's down 96%. It could be down 99%. You couldn't pay me to eat that leather with your mouth. So hard pass. David Martin, INMD. They do. Okay, let's take a look at INMD. I think it's medical devices. All right, this is a broken stock. Let's see if they're generating any cash. They are generating a lot of cash. Margins are holding in. Financial analysis. Let's see here. All right, so the only thing we have to do with a company like this is figure out what's the bear thesis, because this looks good. So it's going right underneath my oil services research, my materials research, my Humana, and my INMD. So I want to understand this. There might be a competitive threat, but this is definitely worth exploring. So good job on that, David Martin. All right. Paul Falcone. Think. Oh, by the way, Paul says 2 more weeks and you'll hit the 5-year mark for your podcast. Pretty incredible, pretty awesome. It's been great to watch you and protect your craft over the last few years. Thanks, Paul. PZZA, I don't know if we covered this or not. I've never liked it since the founder got kicked out, but I can see. Let me just see if they're doing okay with revenues and cash flow. I think this is going to work because this is going to fall in the discretionary bucket. And I've wanted to find some restaurants now that everyone hates them. Looks like cash flow is kind of okay. Gross margin's okay. Yeah, this one definitely deserves a look. So good find, Paul. And let me just make sure here. TXT. This is from JT. I think that's Textron. Yeah. Okay. Now, for me, I don't buy things that are up 5x in 3 years that someone else already took the juice out of that trade. So I'm going to pass. Fundamentals are okay. Cash flow is declining. Stock price is going up. Revenues are flat. Pass. So with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Oh, by the way, next week, not next week, October 10th through the 12th or 9th through the 12th, I'm going to be in Phoenix, Mesa, Scottsdale. Any new or existing client or new or potential clients want to meet for a cup of coffee, reach out at hedgefundtips.com on the contact form, and love to meet people in person. Again, that's Scottsdale, Mesa, Phoenix, I think the 9th through the 12th of October. So we'll see you next week. Have a great one. Bye for now.